Alright everybody, welcome back to the channel. So today, we're looking at something big. The best real estate markets for investors in mind for 2025 and 2026. Now if you felt a little whiplash the past couple years by the market, with all its craziness and wonky interest rates, I've got some positive news. We are officially entering a transition phase. This is the point where things start to shift from that chaotic, high-stress environment into what experts call a normalized cyclical recovery. And this specific window, right now, is where the biggest opportunities are for investors who know where to look. It's all about that early mover advantage, and as we'll see, that advantage might actually stick around longer than anyone first thought. So what does all this look like? Honestly, it's just three large forces in motion. Number one, the Federal Reserve has finally started to change. They're now in a rate-cutting phase, which is gigantic because it actually lowers the cost of debt. Cheaper money means more deals get done. It raises transaction volume, period. But secondly, and this is the sting, this is as the economy also slows. S&P Global are forecasting GDP growth below trend. So one hand is being dealt us on the cheapening of borrowing, but the other hand is that the underlying economy may be slightly softer, and that can temper income growth in properties. And the last piece of the puzzle is what we're calling the landing recovery. Already, we're seeing signs of it. New loan volume is climbing out of the depths of 2024, and commercial mortgage spreads are contracting heavily. So the debt market is finally much more favorable to leveraged investment. It's a delicate dance, but it's creating real opportunity. Okay, so in this environment, you can't just put a dart into a board. You have to be self-controlled. The most significant thing to do is to identify sectors with strong, resilient tailwinds that can navigate through an economic slump. Number one winner is industrial and logistics, distribution facilities, warehouses. The demand here is just relentless because of our persistent demand chain requirements and the relentless growth of e-commerce. It's nearly a utility. It's not cyclical. And then you have data centers. This is the edge. The development of AI, cloud computing, all things digital is creating an international shortage of these types of facilities. The demand is just off the charts. And for the residential market, you need a two-step strategy. 2025 will be a year of coping with peak supply across most markets. But the smart thing is to deploy your capital now for 2026, when that pipeline of supply runs out, and it should leave behind a materially tighter rental market and more rapid rent acceleration. Now, regarding location, if you follow institutional money, you know that they still have a penchant for the Sunbelt, and rightly so. The economic and demographic fundamentals are just too sound. But here's the catch. These markets need perfect timing today. Look at the top three. Dallas-Fort Worth is currently the number one, with incredible job growth. Miami boasts insane demand, but so does it come with insane risk, with UBS ranking at number one in world real estate bubble risk. And Houston offers that classic energy industry and business-resilient grit. The common thread? All of these red-hot sectors are now dealing with a near-term problem: too much material. So, while the long-term story is positive, you have to be thoughtful as to when you invest. As with any opportunity, there's risk, and we must be realistic regarding three major risks. First, supply-driven corrections. In the multifamily sector, specifically in the Sunbelt and Mountain West, we've built so quickly that we're certain to face localized price corrections that can undermine your short-term rental revenue and property values. Second, geopolitical uncertainty didn't vanish. Trade tensions and global instability continue to fray supply chains and can influence the demand by companies to lease space. And third, maybe most pernicious, is climate change risk. This is not a problem of the future anymore. It's now being priced into assets. In coastal markets such as Miami, we're already experiencing through-the-roof insurance prices that strip right out of your profits and suppress property values. Okay, let's head to the engine room of the whole outlook, the Federal Reserve. The expected path of interest rates is the absolute foundation for everything that is taking place in 2025 and 2026. It's unanimous. We are in a protracted rate-cutting cycle. The Fed started with a 25 basis point cut in September of 2025, and S&P Global is looking for more 50 points of cuts up through 2026. What does this do for you? Simply and straightforwardly, the value of your debt is going down. This is the largest stimulator that's most apt to set deals in motion and could even cause cap rate compression. Building values will start to rise on most properties. This is the wave that will lift many boats. But why is the Fed cutting rates? Not because all is well, it's because the economy is going to slow. The justification for easing is related to expected economic moderation. U.S. GDP growth will remain below its sustainable rate in 2025 and 2026. And it's not just us. The rest of the world's growth forecast has been revised down too. Therefore, while low rates are great for borrowing, this slower growth environment covers something. It will supposedly restrain really robust corporate expansion, and by extension, the company's need to lease new space. It's a headwind that neutralizes the tailwind of cheaper debt. That takes us to the most significant and frankly the most confusing part of the investment climate of 2025 to 2026, the infamous cap rate and NOE paradox. Here's what I mean. On one hand, falling interest rates lower your cost of capital. That typically translates into higher property values and lower cap rates, which is great for the value of your existing portfolio. But at the same time, that downward economic growth that we were talking about can stifle a building's fundamental ability to make more money, its net operating income, or NOE. Rental growth could decelerate. So the risk is this. You're paying too much for a building because leverage is cheap, hoping that value simply will just keep on going up. But unless the asset itself is generating more NOI, you're speculating on financial engineering, not on core performance. And that's a very perilous thing to do. The best performing investors will be putting money into properties that can generate solid NOI growth in a slowing economy. So in this tough world, what numbers should you be obsessed about? It's not so much about the price to buy anymore. Above all, you need to be laser focused on cash flow. This is your net income after all expenses, including your mortgage. With insurance fees and construction fees still so uncertain, cash flow is what keeps your property solvent and you sleeping well at night. Next, keep an eye on cap rates. They'll be trending in line with interest rates, but don't look at the national average. You have to compare them to specific supply pressures in your target market. Low cap rate in a market that's about to get oversupplied with new apartments is a trap. And finally, your debt service coverage ratio, or DSCR, is your best friend. This is how readily your property income covers its debt expenses. And with lending now finally bouncing back, a strong DSCR is your golden ticket to securing the best possible refinancing or acquisition financing. And now let's talk about something that people like to overlook, but can make or break your deal: future tax changes. There are 3 big ones to watch out for. First, the mortgage interest deduction. The $750,000 limit was supposed to increase, but a new proposal makes that limit permanent. That has a direct impact on high-end residential markets, in effect limiting the deduction on mortgages of approximately $937,000. Second, the SALT deduction. The existing $10,000 limit is being made permanent, but a new, higher limit of $40,000 is being applied to eligible taxpayers starting in 2025. And third, and this is a humongous one, the Low-Income Housing Tax Credit, or LIHTC, is set to see its huge expansion. State allocations will increase dramatically from 2026 through 2029. And the minimum project size for those using tax-exempt bonds is being cut back severely. That's a huge policy win at the back of affordable housing. Let's double-click on that light-hip expansion, since it's a big deal. The reforms starting in 2026 bring about an interesting, policy-driven incentive that radically changes the risk-return dynamic for affordable housing. The government is doing 2 things here. First, they're adding more subsidy capital into the market by widening the state allocations. And second, they're making it much easier and cheaper to finance the projects by lowering that bond financing minimum. And while the rest of the economy grapples with economic risk and supply overhangs, The space of affordable housing is getting this built-in defensive position. If you're an investor wanting predictability over the long term, you need to be factoring these 2026 policy benefits into your models already. Switching gears back to the broader residential market. The narrative there is one of gigantic supply problem. We are seeing a volume of new apartment construction not experienced since the 1980s, and it's incredibly focused in the Sunbelt and Mountain West. So, for 2025, the challenge is clear. Excessive levels of supply will lead to relatively tame rent growth overall. We're even expecting vacancy rates to rise later in the year as all this new supply finally gets into the market. But that is where the two-stage strategy comes in. The timing is 2026. That is when new completions are forecast to drop by a staggering amount. The pipeline will be drying up, leading to a tighter market and laying the basis for frenzied rent growth. You have to look past the 2025 storm to the rebound of 2026. Now, under that modest national rent growth number is a crazy level of diversity. Market performance is diverging crazily. The evidence shows a highly distinct bifurcation. High-permitting metros with lots of new construction actually experienced average rents falling during early 2025. On the other hand, markets with low permitting and tight supply experienced healthy, positive growth. The best example is Boston. As the national average inched along slowly, Boston had year-over-year rent growth far exceeding that average, merely because it has a much more diversified and manageable pipeline. This is evidence that market selection is more important today. Now let's look at an industry where the story is just enormously positive: industrial and logistics. The sentiment here is, and I'm quoting, sky high. It's being driven by secular, long-term trends: the need for logistics, warehousing, and the total reorientation of world supply chains. It's not only cyclical, it's just the underpinnings of the modern economy. The numbers don't lie. Net absorption, or net space leased up, will be an astonishing 150 million square feet in 2025. And get this, it's going to accelerate to 175 million square feet in 2026. Growth that size in a decelerating economy speaks for itself. Strategic positions of prime logistics properties are as near as it gets to a high-demand, low-risk investment. The story for old-fashioned commercial real estate, or CRE, is not as consistent. It's more of a story of two cities. The market is completely polarizing. Take the office market, for example. It's the flight to quality. Newly developed, modern, amenitized buildings are performing well. Top-quality office vacancy is nearly 5 percentage points lower than for older, non-core stock, and that gap will grow. The non-core office space is in crisis mode. On the flip side, you have data centers, with demand so red-hot it swamps global supply. That's creating huge investment opportunity, with investors like Blackstone pouring billions into building mega data centers and hyperscale campuses. Sentiment here is one of the strongest for any asset type. This polarization is not accidental. It is driving a record reallocation of capital. The billions going into data centers are a deliberate move away from crumbling commercial property. You must consider the correlation. They're pouring vast sums of capital into the safe, high-demand niche of digital infrastructure on one hand. They're viewing older office buildings as assets that would require gigantic, high-risk investments to convert or reuse on the other hand. This is structural change. It's not a trend. Capital is structurally favoring essential infrastructure over traditional kinds of real estate with high risk of obsolescence. This puts long-term, sustained pressure on secondary and tertiary office buildings. So with all of that in mind, where are the experts putting their dollars exactly? The ULI and PwC Emerging Trends Report is the industry standard for investor sentiment, and their 2025 rankings come out. The Sunbelt is still in the lead. Dallas-Fort Worth captured the #1 spot, displacing Nashville after 3 years. Miami holds on it too, despite its weaknesses. Houston and Tampa St. Petersburg complete the top 4. The rankings are breaking in favor of a combination of stability, size, and those solid long-term fundamentals. But let's examine a little more closely that Sunbelt volatility, because it's not hypothetical. Dallas-Fort Worth, while number 1 ranked, is really in a price correction mode, recording annual home value declines as of mid-2025 because of all that fresh supply. Miami is the mystery. Great demand, with the highest global bubble risk and intense climate vulnerability that's already causing insurance costs to rise. And Tampa St. Paul. Pete did have the sharpest short-term price decline of all the large metros, with housing values going down for 8 months in a row. That's the conflict between great long-term optimism and painful short-term supply stress. Well, if the Sunbelt is a little too roller coaster for you right now, fear not. There are alternatives. Look for markets that offer resilience in terms of lack of supply. The star example is Boston. While nationally average rent growth averaged around 1.5%, Boston yielded an extraordinary 6.8% effective rent growth year over year. Why? Because its supply pipeline is in balance. It's not overbuilding. This is a different solution. Hard, short-term revenue expansion through concentrated attention to tight inventory instead of reckless growth. Other markets, like Manhattan and Charleston, South Carolina, are also being identified as movers and shakers, deserving a close look. So how do we treat these Sunbelt price declines? Don't panic and call it a structural failure. See it for what it is, a natural market-clearing mechanism. The forces that drive the region, the population expansion, the employment expansion, are still all in place. But the tidal wave of new construction from the prior boom is now confronting a moderating economy. This inventory boom is inducing the price declines in 2025. It's a correction, but it's one that has to be done in order to absorb all this overhang supply. And the intelligent money is penetrating this. Sophisticated buyers are more than happy to weather this short-term uncertainty in 2025, to get in at better valuations, positioning themselves optimally for the long-term capital appreciation and resumption of income growth that will come with the supply glut finally fading away in 2026 and 2027. The cycle reverses. The trick is to be educated, be discriminatory, and be strategic. Thanks for watching, everyone. Please reply in the comments below with your number 1 target market for 2025. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.